As such, I'm going to introduce Mr. Fletcher. As you know, he's got a lot of years of experience, 30 years of experience in this, formerly with Fidelity for 23 of those. And of course, for those of you that have owned the biggest and most well-known funds in the world from Fidelity, well, Tom Fletcher was the guy pulling the trigger behind the scenes. And now we're lucky enough to have Tom here pulling the trigger behind the scenes, but also he's comfortable enough getting in the front lines here tonight, especially to talk to you about what we see. So with no further ado, Mr. Fletcher, welcome to the call. Thanks for being here.
So as John said, I've spent 30 years in the asset management business, probably north of that, trading for the funds, but I also traded for various sectors of Fidelity. Probably have spent most of my time in the technology, media, and telecom space, otherwise known as the TMT sector, trading Google, Amazon, whatever. It was a lot of fun. So I joined Alex and John at U.S. Wealth in January 2013. Haven't ever looked back. And then during this call, we're going to be talking about investments. And there's a whole lot of important stuff going on in the world right now, more than probably in past calls. So we're going to chat about markets, the economy, the Federal Reserve, the spate of recent volatility we've seen, our portfolio positioning, and what we all need to do to remain calm. So in other words, the usual stuff you hopefully expect from an investment call. So despite what the press is telling us, we continued to be in the longest bull market in U.S. history. This one began in the Great Recession in March of 2009. And if I'm doing my math correctly, that would give us a grand total of about nine years and 9 months so far and counting. And during that period, the S&P 500 is up 295%, actually a little bit north of there. It is also the second longest U.S. economic expansion we've ever had. And if growth makes it till next summer, which I believe is June, it would be the longest on record. And the reason why we've gotten to this point in the first place is we've been in essentially what's known as a Goldilocks economy. The economy's been growing, but it hasn't been growing too fast. Interest rates have been historically low. Likewise, inflation has been historically low and has remained manageable. The Federal Reserve in general has been accommodative. Banks have stopped failing, and balance sheets in the financial sector have improved significantly since the Great Recession. We've also had a very strong labor market. Since 2009, when the unemployment rate was at 10%, the U.S. has created nearly 20 million jobs, and the current unemployment rate is the lowest in 49 years at 3.7%. Now, the Federal Reserve bought bond assets early in the economic expansion through their quantitative easing programs to boost the economy, otherwise known as QE. This is known as monetary stimulus. Last year, Congress passed the Tax Reform Act, and this was known as fiscal stimulus. There have been a lot of other tailwinds recently in the markets as well. Earnings have been accelerating. This past quarter, earnings outpaced expectations and grew at 28% year over year. Business confidence readings are at or near their highs. The consumer is strong. They continue to spend. And yes, the Federal Reserve has been raising rates, but it's not because of runaway inflation. It's because the economy's been growing, and they don't want it to overheat. So with all these positives, why has the market been so volatile recently? What's been going on? Well, really, there are three major factors unsettling the market, and most of you can probably guess what they are. The first one is trade friction. The second is interest rates. And the third one, the most important one, is the economy, which could be the result of the former two. I'm going to try to go through chronologically my best to see how these factors have impacted markets so far this year. So the volatility really started in earnest in February of this year when we had our first 10% correction in over 2 years. And that was after the president initiated tariffs on China for trade infractions. And we also had an employment survey, a January employment survey that was reported in February that indicated that inflation was more or less reawakening. So that created a sell-off. The sell-off, again, was more than 10%. It lasted pretty much the month of February before markets finally regained their composure and began focusing again on earnings and improved economic growth. So essentially, we had smooth sailing from March until October. In early October, Federal Reserve Chairman Powell, who's pretty much new to the job, was interviewed by PBS, in which he indicated that the Fed was nowhere near a neutral interest rate. Additionally, during the interview, he indicated he wasn't even aware of what that neutral interest rate would be. And those comments that he made seemed to open the floodgates because volatility surged after the interview. Markets were clearly concerned that there now would be no end to the rising interest rate environment. So the Dow lost over 1,400 points in the next 3 sessions. So just a reminder, rising interest rates tend to be a brake on economic growth. If rates get too high, eventually they can choke off an economic recovery, which can in turn impact stock prices. Also in October, third quarter earnings were coming out, and while results were generally excellent, as I mentioned previously, several high-profile tech stocks, which had been market leaders, provided guidance that were below Wall Street expectations. Now, I'm sure many of you have heard of the FANG stocks, that's F-A-A-N-G, which are the most high-profile of the tech group that we have. And that consists of Facebook, Amazon, Apple, Netflix, and Google, the parent company, Alphabet. Out of those 5 names, 4 either reported lighter revenues than what we were expected or disappointing guidance. At this point, markets began to slide on concerns about the potential for slowing economic growth. And also around this time, the price of oil dropped a stunning, I should say, 34% in less than 2 months and went from $76 a barrel to $50. A major reason is the overproduction that had created a supply glut. You can blame the U.S. for that mostly, but there were also concerns that global demand was slowing, and that indicated that economic growth could have been potentially slowing as well. And I might add here that international stocks have been weak all year on their economic growth outlook and trade concerns. So Thanksgiving week, Fed Chairman Powell again made the news. Probably after viewing the elevated volatility, he changed his tune from the previous month and announced in a speech that instead of being nowhere near a neutral interest rate, the Fed was now, quote, just below neutral. Though he didn't disclose, again, what that rate would be. But this immediately had the opposite reaction and brought euphoria to the market in hopes that interest rates were potentially pausing. So the Dow rose over 1,000 points over the next few sessions on the news. So I'd segue here to say the market had been looking for 1 rate rise at next week's Federal Reserve meeting and 3 more next year. So after the Powell comments, analysts expect 1 rate hike next week and just 1 and not 3 for 2019. So net, a positive development on interest rates. We're continuing with this volatility story. So the next milestone for the year was the anticipated meeting between Presidents Trump and Chinese President Xi at the G20 summit in Buenos Aires. Expectations had been low going into the meeting, so when a 90-day delay was announced after the summit, it was again another welcome development that propelled markets higher, at least initially. However, the lack of details and a whole lot of confusion about the substance of the upcoming talks quickly put a damper on the rally, which turned into a market rout the following day. So essentially, this is a classic buy the rumor, sell the news scenario. In addition to all we've discussed so far, the bond market in the first week of December rather suddenly sent a signal that economic growth might be slowing. We're going to be talking about that more in a minute. And if that weren't enough going on, last week China announced they had arrested, at the request of the United States, the CFO of the largest cell phone maker in China, a company called Huawei. I believe I'm pronouncing that correctly. It's complicated, but she was arrested for violating Iranian sanctions and will presumably be extradited to the U.S. for trial. So to quickly summarize, between the arrest, which could jeopardize a permanent U.S.-China trade agreement, the bond market sending mixed economic signals, the price of oil dropping 34%, a flip-flopping Federal Reserve, concerns earnings may have peaked, and weakening international growth have understandably kept markets on edge. So let's segue here to the bond market. So one of the biggest topics these days in the market is talk of the yield curve. I'm going to spend a little time here discussing the general implications because it's been moving asset prices. It can be a bit technical, and if any of you are interested in learning more about it, I'd be happy to circle back with you at a later time and get into specifics. So here it goes. Analysts pay very close attention to the direction of U.S. government bonds to try and predict where the economy is headed. One of the most closely watched indicators in the bond world is the difference in interest rates between the 2-year Treasury bond and the 10-year Treasury bond. So typically in an environment where the economy is growing, 10-year Treasury bonds will have a higher interest rate than 2-year Treasury bonds. Now, when the interest rates between the two bonds narrows, which has been the case recently, it can signal to bond traders that they are less convinced that growth is here to stay. And this is called the flattening curve. But we've heard a lot of talk recently about a yield curve inversion. What does that mean? In this case, the yield difference between the 2 and the 10-year gets upended, where the 2-year has a higher interest rate than the 10-year. Often when that happens, it can be a fairly accurate predictor and can signal the potential for an economic slowdown or even a possible recession, anywhere from a few months to a couple of years down the road when the yield curve inversion takes place. Now, it's important to note we haven't seen a yield inversion in this economic cycle between the 2 and the 10-year bond. However, the first week of December, we saw one between the 2, 3, and 5-year bonds. And so there's been a lot of scrambling going on to determine what the implications are there. Regardless, it's raised concerns about slowing economic growth and has put pressure on equity prices. It's important to note, though, that even if the 2 and 10-year treasuries invert, which again, it has not happened, but if it did, a recession could be years away and not necessarily right around the corner. So I apologize if I confused you with all the gibberish. However, the one takeaway from all this is the market has become more focused on this topic and is more concerned about the U.S. economic growth outlook slowing than it has been. Now let's switch over to tariffs. What's the tariff situation all about? Well, there are 3 issues that are being cited. The first one being cyber espionage, such as China stealing our F-35 fighter jet plans, which has been the accusation, or the Marriott hack last week. The next one is forced technology transfer, meaning multinational companies from the U.S. are forced to provide proprietary technology to gain access to Chinese markets. The last one being intellectual property not being protected by Chinese companies. Think in this case of pirated Disney movies. So after the G20 summit, the U.S. agreed to postpone any additional 25% tariffs for 90 days, which is March 1st, while the two sides attempt to hammer out a permanent accord. We think the president badly needs a victory and wants to get a deal done, as he's had some recent political setbacks between the Mueller probe, the midterm elections, and the GM situation, laying off workers. And he also seems to be focused on the stock markets. So I think it's fair to say that both countries have a lot to lose, a lot to stake if no agreement's reached. And we think that it's likely a compromise deal will likely be reached. And I think the market's leaning this way as well, although it may not be in the next 90 days, something to keep in mind. The Toronto arrest is a wild card. We'll have to see how hard the Chinese press on this issue, although the president says he's willing to intervene if that would help provide a deal. Now, tariffs have a huge impact on the economy and create a lot of uncertainty. Tariffs raise the specter of inflation down the road as imports become more expensive. They affect corporate spending. Supply chains are in doubt. Corporations don't know where to build factories or deploy capital. It affects raw material prices. So whether you're in favor of them or not, there's no question the trade issue has been responsible for a substantial amount of the market volatility we've experienced this year. And it seems like every day markets move one way or another based on the latest trade headlines. So again, we think a trade agreement where both sides could claim victory would be an enormous shot in the arm for markets. The opposite, of course, could be true if none were reached. In the meantime, we think it's just best to fasten your seatbelts while these talks continue. There's going to be a lot of headlines. And we think, and I'm sure you'd agree, that markets have been behaving pretty badly lately. And it's also important, though, to put into perspective that with all the volatility we've had, the S&P is essentially flat year to date. Although other markets and asset classes have fared a lot worse and some are better. We remind you that markets are dynamic organisms. They are not a central entity, but rather a collection of individual buyers and sellers. And while markets consider all data, they can also become irrational, and they can become emotional and also unpredictable. And as John told you, we try to remind you as our clients that markets occasionally do throw a tantrum, and they drop 10% or more, which on average happens about once a year, or it can get worse than that on occasion. This year it actually happened twice, but keep in mind there wasn't a correction last year. While it's true we think markets are leading indicators, and they tend to be, they do tend to peak before the economy does. And it's also important to note there's a pretty good saying that markets have predicted 9 of the last 5 recessions. So in other words, there have been several occasions when markets roll over without indicating an economic decline. A great example of that, which I experienced firsthand as a trader, was the crash of 1987. Despite the more than 22% drop in equity prices, there was no economic slowdown afterwards. So we're not saying here that this recent price decline is completely without merit, but it's also good to focus on the long term. Yes, oil prices have weakened, bonds are indicating a possible slowdown, and tariffs are front and center these days, but there's been a lot of economic data released regarding fourth quarter. There hasn't been, regarding the fourth quarter, and obviously we have had none yet for 2019. The last earnings report we've had have been based off of the September 30th quarter, and again, we mentioned that the reports were generally pretty good. The economic data we've had that's been coming out recently has also been okay, and the Fed, which likely sees a lot more data than we do, remains quite positive on the U.S. economic growth outlook. And inflation also remains under control despite tariffs and despite a 3% jobless rate. So we think it's a reasonable conclusion that economic growth may slow, though, in 2019 as the benefits of tax reform wears off. We haven't seen any signs yet pointing to a recession. What we expect is that corporate earnings has likely reached its peak, but growth will continue, but just not at the same pace we've seen. So realistically, we don't expect the wand to be waved and trade issues, interest rate hikes, and slowing growth concerns to just disappear. And as a result, we'd expect the volatility which we've experienced in this last few months to continue throughout a good portion of next year, especially as the trade negotiations continue. So in anticipation of that potential elevated volatility, we've made some portfolio changes over the last couple of months. We reduced our exposure to growth and small cap stocks, which tend to be a little more economically sensitive. We added positions in the utility, consumer staple, and healthcare sectors, which tend to be more stable and defensive in nature. And again, this is mostly a precaution against higher volatility and a potentially slower growth environment. Overall, we still remain constructive on the market over the long term. Markets go up and go down based on continuing headlines. Volatility should be considered a normal part of investing. We know it's tough, but our advice to you is please turn off CNBC if possible and avoid paying attention to daily price movements. Really, in the scheme of long-term market cycles, this volatility is nothing but noise. And as John mentioned, study after study has concluded that trying to time market moves can be one of the largest financial mistakes you can make. The hardest part, as John had mentioned, is getting back in. So if you take this particular market, for example, given the overwhelming negative sentiment we're seeing, if we had 1 or 2 positive headlines hitting the tape, we could experience a 10% upward move or more in any given day. Lastly, I'll just close with this. Just today, there was a survey out that indicated retail investor pessimism was the highest level in over 5 years, since 2013. Anytime investor sentiment hits an extreme rating, it tends to be a contrary indicator. So in this case, it could definitely be a positive. And just one last thing, the last time it hit this low level, stocks rallied 16% off of that number. And with that, I'll field any questions.
Great. Thank you, Tom. What a great set of information there. So we actually do have a few emails, and so again, if you have any questions, please email me. This is Alex Weiss at aweiss@uswealthmanagement.com. And one is about our friend St. Nicholas. We have a Santa Claus rally question. Someone said, "What is it? I heard about a Santa Claus rally. What is it, and can we expect one this year?"
That's when Santa Claus takes all his tips and goes and invests all his money and he moves the markets, right? No.
Well, there is such a thing as a Santa Claus rally, and more years than not, December tends to be a pretty quiet month. And the last 2 or 3 weeks of the year tend to be a Christmas gift, and Santa Claus does come to town once a year. So yes, there is a factual aspect of that. Will there be one this year? Based on that last data point I gave you, I think it's more than likely. And I think you've seen the last couple of weeks we tested some low levels. So I pay attention to charts. We tested some low support levels and we've held. And I think now we're going to test some upward levels.
We don't have a question, but we have a comment that said, "Thank you so much, Fletch. Great information."
Awesome. Thank you. Thank you for saying that.
Unanimous in the South Shore.
Unanimous or anonymous? I think it's unanimous. I'd say it's unanimous.
I was a math major, not an English major.
Further questions, we're going to get ready to sign off here.
And under our time allotment of a half an hour, so we're pretty happy about that.
Yep, by 2 minutes. Better than not, right? Well, again, thanks everyone for joining in today.